What if I told you there's one massive factor that could completely derail the Federal Reserve's plans and catch every investor off guard? While everyone's celebrating record market highs, there's a hidden wild card that most people are completely ignoring. Right now, we're witnessing something extraordinary. The Dow, NASDAQ, S&P 500, and Russell 2000 have all hit record levels simultaneously. The IPO market is absolutely booming, and investors are getting increasingly optimistic about potential interest rate cuts. But here's what nobody's talking about. There's a game-changing element that could flip everything upside down. Let me break down what's actually driving these record-breaking markets. First, we've got the Federal Reserve finally shifting toward a rate-cutting cycle. Now, before you get too excited, Chair Powell made it crystal clear that this isn't necessarily the start of aggressive cuts. They're being extremely cautious about their next moves. Second, there's substantial fiscal stimulus expected to inject into the economy in early 2026. This should provide significant support for continued market growth. And third, when you examine corporate earnings forecasts, especially looking toward 2026, we're anticipating much broader participation across different sectors and company sizes. But here's where things get interesting and potentially dangerous. While these fundamentals sound amazing, the bond market is telling a completely different story. Bond yields are climbing higher, with the 10-year Treasury approaching 2-year highs. This suggests that bond investors aren't convinced about future rate cuts at all. So what's creating this disconnect? The big wild card that's keeping Federal Reserve officials awake at night is inflation uncertainty. Despite all the positive economic indicators, inflationary pressures are starting to creep upward again. This creates a massive dilemma for policymakers who want to support economic growth while preventing inflation from spiraling out of control. Here's what makes this situation even more complex. The labor market has definitely softened, which typically would support rate cuts. However, the overall economy doesn't appear headed for recession. Economic growth is moderating, but not collapsing, creating this unusual middle ground scenario that makes Federal Reserve decisions incredibly challenging. The real kicker? Experts predict inflation numbers will continue climbing into early 2026, particularly as tariff effects begin filtering through consumer prices. This timing couldn't be worse, as it directly conflicts with the market's expectations for accommodative monetary policy. What does this mean for your investment strategy? We're potentially facing a scenario where markets remain elevated due to strong fundamentals and earnings growth, but monetary policy becomes less supportive than anticipated. This creates a delicate balancing act that could lead to significant volatility. The key takeaway here is that while current market conditions appear incredibly favorable, smart investors should prepare for potential policy surprises. The Federal Reserve's uncertainty around inflation represents the single biggest threat to continued market rally. I urge you to engage with this content by subscribing to our channel for more insights on these important topics. If you found this video informative, please give it a thumbs up and share it with friends and family who may also benefit from this information. Your support helps us continue to provide valuable content and fosters a community of informed viewers.